sound that's in the air. It's rock and roll. 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 It's rock and roll.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's the Hump Day edition of The Real Investment Show. It means we're halfway through the week. We're getting there, folks. So it's been fun this week, right? Been a lot of volatility so far, and everything's kind of starting to settle down today. We'll talk a little bit about this morning. Today is mega cap earnings parade day, but it's also a very busy economic day as well. We have a lot of economic data coming out today. We also have the Fed announcement this afternoon. So when Michael Leibowitz is here tomorrow, we'll of course go through all of what they talk about today. Of course, the big concern is, what are they going to say about future rate cuts? It's the expectation right now is that the Fed is not going to cut rates today. They will hold pat at this meeting. The data certainly supports them right now, holding pat at this meeting. Recent economic data has been a little bit better than expected. It's not fantastic, by the way. The data is not wonderful. It's just better than expected. But we're looking right now, according to the Atlanta Fed, of putting out a 3.2% GDP for the fourth quarter. Now, let me clarify that for you real quick. So when the Atlanta Fed says, hey, we're going to have 3.2% growth in the fourth quarter, that is annualized. So you have to take that number, divide it by 4. That's what the economy grows at, or what they're expecting the economy to grow at in the fourth quarter. So again, they take that number, annualize it, and say, okay, if the economy grew at the same rate for the next year, it'd be 3.2%. So, it's a little bit, deceptive. I'm not deceptive intentionally, but just you have to understand what you're looking at when you take a look at the numbers. But that is a little bit stronger than what we saw in the third quarter. So the economy's doing okay right now. Now, again, what the Atlanta Fed says and what GDP actually turns out to be from the Bureau of Economic Analysis is always different. So, I'm probably expecting somewhere a little bit weaker number coming out of the BEA. We'll see what happens when we get that report here, I think next week, if I'm not mistaken. So we'll see. Now, for the Fed, though, again, that's strong enough to keep them on hold. They still have this issue of making sure inflation is being under control, so probably no rate cut today. The key is going to be what they say today in terms of their language. Do they hint at a longer pause? That would not be good for stocks, right, if they do that. So do they hint at a longer pause, or do they just kind of reiterate what they've been saying over the last several meetings, which is, hey, we're watching the data. We still expect that inflation's coming down towards our 2% target. We'll act accordingly. So as long as they continue on that same vein, markets should take that in stride pretty much, and we'll see what happens from there. That'll also have a lot to do with bond yields. Bond yields are higher than where they should be. We've talked about the term premium, that sentiment of the markets have a lot. We have the record levels of short positions right now against treasuries. That's been holding yields up above where they should be trading. Yields have been coming down over the last couple of days. In particular, they're down this morning as well. So we'll see if that kind of carries through the meeting today. We'll find out. Outside of that, though, again, a good bit of economic news out today. That's going to really be overshadowed. We have Microsoft, Meta, all reporting this afternoon. I'm going to go through some of the earnings expectations with you right now. ASML, they are the big chip manufacturer and have a big footprint in chip manufacturing and in the AI space. They reported much better than expected earnings today. That stock's going to be up about 5%, but that's alleviating a little bit of that concern about DeepSeek that we saw yesterday. And speaking of that, NVIDIA had a great day yesterday. It was up about 9%, kind of rebounding off those lows. So again, you had this kind of big knee-jerk reaction, very overvalued stocks. In general, the whole market is overvalued, lots of exuberance. And so again, as we talked about yesterday and touched on a bit, we had this unexpected exogenous event that caused a rapid reversal. Now, and we said, hey, just go do something else on Monday. We said just leave it alone, let the market sort it out, and the markets have started to kind of relax a little bit. Stocks are rallying back. So, now is where you go, okay, I had much more risk in my portfolio than I thought I had, right, on Monday, because that became very evident. Now you've had this bit of a recovery here. So use this recovery in these stocks, right? So if you had way too much NVIDIA in your portfolio, trim it down, right? Reduce that risk a bit. Again, I'm not saying that NVIDIA is over. I'm not saying anything like that. But again, if Monday gave you heartburn and kept you up all night, reduce your risk in your portfolio. Doesn't mean sell everything, but just reduce and rebalance your position sizing accordingly, and you'll do better over time. So let's talk a little bit about the market, right? And this is what you need to know before the bell. So interestingly enough, I've showed you this chart before. If you're driving, please don't try to look at your phone. This is on the video. You can download it when you get home. But I've talked about money flows, and money flows are so important because if money flows are positive, that gives asset prices support. If they're negative, it takes away from that support. So if you pay attention to where money is flowing one way or the other, it'll help you kind of determine where the markets are going to next. And despite the sell-off on Monday, money flows have continued to come in the markets. In fact, yesterday, the triple Qs, right, that's the ETF for the NASDAQ 100, had its biggest inflows since 2021. So that, remember, back in 2021 was when we had checks to households, right? So everybody had money to spend. Largest inflows yesterday since 2021. So again, plenty of money still sitting out there wanting to come into the markets. Monday was not the watershed event that a lot of the bears were trying to make it out to be. Again, we're not bullish or bearish, but there was a ton of bearish headlines out on Monday going, oh my gosh, this is the watershed moment for the markets. The crash is coming. That's hard to do that when money flows are continuing to increase in the markets. Markets are not overbought yet. We're still on a very solid buy signal. Again, everything is okay for the market. Doesn't mean we're not going to have a bit more volatility here, but markets are holding well above the 50 and the 20-day moving average. This morning, we're pointing a little bit higher today. Again, that can certainly be changed later on today, by earnings as well as the Fed. But again, the important thing here is to watch those money flows. Right now, they're positive. If those money flows start to turn negative, and we've seen this before. If we just go back to mid-December, early December, we were talking about in early December, we said, hey, there's very likely we're going to get a correction because we're going to have distributions and things about mid-month. And the market was holding up just fine early December. And everybody was like, well, Lance is wrong because, we're not, markets are doing fine. They're near all-time highs. But money flows were declining and going negative, and then the market finally gave way. And again, that's why you pay attention to money flows. Prices can stay elevated longer, but money flows will ultimately dictate those corrective moves in the action. So pay attention to money flows. They're so critically important over time. Now, other things that we need to be paying attention to right now, of course, is that we've got the dollar back on the march today. Again, dollar strength has been really one of those things that has also been kind of underpinning the market to a large degree. We had a nice correction of the dollar. Dollar starting to rally back off key support. We're decently oversold on a couple of levels. Relative strength is starting to pick back up. So we may be in kind of mode here for another kind of counter trend rally in the dollar. That's certainly going to potentially impact some economic data as well as earnings data because, again, stronger dollar impacts exports. It also impacts companies that have international revenue. Remember, 41% of all corporate revenues are from international sales. So that's our exports. So if the dollar gets stronger, that weakens those sales and that potentially impacts corporate earnings. And with the dollar having been this strong, as we go into really more of these international company reports, that may weigh on those company earnings reports in particular, because if they didn't hedge that currency relationship enough, could certainly have underpinned their earnings. So kind of watch the dollar as we get further into earnings season. But again, today starts. Today, tomorrow, Apple, Microsoft, Google, all the big boys out, except for NVIDIA. That's later in the month. We'll get there. So anyway, that's what you need to know before the bell this morning. We'll be right back with more of The Real Investment Show. Go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Will you be turning 65 in 2025? Happy birthday! But there's a Medicare special enrollment period in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid those gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Headline on the news this morning: Nation's report card reveals historic plunge in math and reading proficiencies. For 8th graders, it's at 33% for math and 28% for reading. Yeah, we're going to win this whole AI race. It's going to be kind of an issue. I have very bright lights this morning, Brent. Brent's snarling at me. We have some lighting issues this morning. Anyway, we'll get it all worked out here in a second. A couple of things very quickly. Here, let's do this. Let's talk a little bit about earnings today. So this afternoon, we have Microsoft, Meta, Tesla out this IBM. IBM also reports this afternoon. They also have a foothold in the artificial intelligence space. That will work itself out, a bit. One of the things that IBM always misses on, and it's almost a guarantee, they're going to miss on their currency hedging of some sort. So if they miss earnings today, the excuse will be their currency hedges were impacting their earnings. Again, I was talking about the dollar a minute ago, but IBM has a historical tendency to mess up their currency hedges. There's a lot of earnings out today. We are right in the midst of earnings season. So, companies from the NASDAQ reports today, Hess, Corning, General Dynamics, ADP, Progressive, Danaher, the list goes on and on. It's ServiceNow. There's just a ton of earnings reports. It's going to be very busy from here through next Friday. Next Friday, we will have 80% of all the S&P 500 will have reported earnings by next Friday. So, that's going to be kind of one of the drivers of the markets for the next week, volatility-wise, particularly positions that you own, are all going to come down to these earnings announcements. Expectations are high. The risk of a miss is fairly high. Earnings, right now, companies that beat earnings have been sort of rewarded for beating earnings, but not dramatically. We're not seeing stocks up 20, 25, 30% for beating earnings. The earnings beats have been slightly rewarded. Misses have been brutal. So, we'll see how this works out. But again, today really starts the mega cap earnings parade across the board. Then tomorrow, we have Apple, Visa, MasterCard, Blackstone, Thermo Fisher, Caterpillar, Comcast, and the list goes on from there to a large degree. And then Friday, ExxonMobil, AbbVie, Chevron, Colgate-Palmolive, and then next week. Now, again, everybody's kind of paying attention to NVIDIA. NVIDIA won't report until, I believe, here, let me just get you the exact date here while instead of me just kind of guessing at it. They report very late in the year and or in the quarter. Generally, it's right towards the end of the entire earnings season. Their earnings report is going to be February the 20th, right around there. So it's a while out there yet. But again, that's the one everybody wants to watch, right? Because of this whole AI thing. What is, between now and the 20th, NVIDIA will have plenty of time to absorb the impact of DeepSeek. And then I would expect a very robust response by the CEO of NVIDIA back towards DeepSeek. So we'll see what happens. But again, ASML today reporting very good earnings. They're in that same space. That stock's up about 5%. We'll see if that rally holds across the board. Now, again, NVIDIA had a huge crack. Now, there's a big gap in that stock right now that has to get filled. So there is, if you're long NVIDIA, and this is going to be one of the big questions, that when you're holding that stock, you have a big gap down like that. It did hold some levels of support, rallied back above the 200-day moving average yesterday. It needs to hold that level, and it's got to fill that gap that had from Monday. That's going to be a bit of a challenge here, but gaps do get filled generally. But again, it could be a bit of a volatile process getting there. So if you're long NVIDIA, and this is what I was saying earlier, is use this rally. If Monday really gave you a lot of heartache in your portfolio, it's because you had too much risk. A good example, our 60/40 allocation model was down about 14 bips on Monday versus the market being down 1.5-ish, right? So again, very easy to weather that. When you look at your portfolio, you had a couple positions. We had NVIDIA, we had GE Vernova. Those were down 15, 20% each. But the rest of the portfolio held up well. You had a lot of stocks rallying on Monday. Then it was interesting, yesterday, everything that rallied on Monday sold off, and everything that sold off on Monday rallied. So again, the market did this rotation thing, and we see this happen all the time. But this is why when you take a look at your portfolio, and we were talking a lot about risk management on Monday, Tuesday in particular here on the show, is this is the moment, right? This right here, this is the moment that you go take a look at your portfolio and say, okay, I didn't like Monday. I've got too much risk. I need to rebalance something. And so this is where you start taking a look at your weightings. If you've got a lot of positions in your portfolio that are, let's just say that you got 10 stocks in your portfolio, just example. 3 of them make up 50% of your portfolio and the others make up the other 50%. You have concentration risk, right? So rebalance, right? Rebalance between those 10 stocks, get a more equal distribution. So how do you do that? How do you weight stocks in your portfolio, right? So it's a great question. So this is where you have to really define what you're trying to achieve. So if and again, the way we do it is because we have to, right? We're kind of forced by, our clients in particular, that we provide performance relative to their expectations, right? Which is either the market or a benchmark hurdle rate, whatever it is. Generally, it's the market. So in order to provide performance relative to the market, I have to weight my portfolio relative to the market. So in other words, if the S&P 500 has a 20% weighting in technology, If I have a 10% weighting in technology, I'm going to underperform the market if technology is performing. If I'm really overweight staples, which has a much smaller weighting in the S&P 500, but I put all my money in staples because I'm super conservative, staples really haven't performed that well this year. They've been underperforming, and so my whole portfolio is going to drag. So if I want to have relative performance, then I need to weight my holdings relative to the market. But there's some caveats to that, of course, and you've got to be a little bit careful about where you're, because again, NVIDIA makes up a very big chunk of the S&P 500, so does Apple, so does Microsoft. So you have to think about what you're trying to achieve and then reweight your portfolio accordingly to try to get those goals. Now, there's also what's called absolute performance, right? Which I think personally is a much better way to manage your portfolio, which is forget the index. Now, I can't do this, right? I would love to manage on an absolute basis. That would just thrill me to death, and I'm going to explain to you why. Can't do it because all my clients look at the S&P 500 and then go, well, why didn't you beat the S&P 500 last year? Why didn't you, market was up 20. Why weren't you up more, right? Because that's the way we're trained by the markets. But what we should do as investors is work on an absolute basis. And absolute performance is simply saying, my goal is I'm going to make 5% a year, 7% a year, whatever that number is. That's my return number. So I'm going to manage my portfolio to generate that return every year. I don't care what the index says. I don't need to be relative to anything. I need my portfolio to do X and generate an X rate of return. Once you do that, you strip out all this noise, this headline risk, everything else, and then you can actually start buying fundamentals. You can buy dividend yields. You can buy a whole lot of things where you can start generating a portfolio that will yield an absolute return every year to some degree. You're still going to get variability, right? There's no way around that. You're going to have years that are going to underperform, but when you start targeting absolute returns, you have much more control over the outcome of your portfolio. Again, I'm unable to do that. You are. You have that capability of doing that. And if you have never thought about it that way, it's something you should at least consider. It takes all the fun out of chasing markets because you're not going to own the high flyers. You're not going to own the stocks that are going up 100%. You're not going to own Bitcoin because that's too much risk for an absolute return portfolio. But if you're looking for stability and growth and income, starting to benchmark against an absolute return rate makes a whole lot more sense. Again, but you have to retrain the way you think. You've got to turn off the media. You've got to turn off the headlines, and that's obviously a very tough thing to do. Anyway, I digressed way off of where I started, which was talking about earnings. So earnings, obviously the big driver here of the markets today. And again, we're going to get some announcements from Microsoft today. I would also expect to hear probably something from Tesla, since he has a lot of money being plowed into AI development as well. When they have their earnings announcements, to actually hear something maybe about DeepSeek or maybe some commentary about that. OpenAI, which has a big affiliation with Microsoft, just made an announcement this morning that they're very excited about the relationship, and some of the things that they are doing with Microsoft are going to be game changers for the whole AI market anyway. So again, there's, as we talked about yesterday, the speed at which AI is now going to develop because of this, what we called yesterday a kind of a Sputnik moment, is going to be quite remarkable. It's going to be fun to watch. Anyway, all right, be right back. Got a lot of stuff to get into this morning. Don't go away. More of the Real Investment Show coming right up. Smash that like button for me while you're here real quick. Just hit that button. I know you don't. Just do it for me.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife got up with me this morning because we have two dogs, as you know, Gunner and Sniper. It's cold outside this morning, and so my wife lets him out on the side of the house.
The Real Investment Show podcast.
The younger one goes out, and he saw a rabbit.
Same show, your schedule.
And he takes off after this rabbit. My wife is now in furry slippers and her PJs in 25-degree weather outside, walking fast after the dogs, right? Silently whispering at them to come back because she can't yell. It's 4 o'clock. She'll wake up all the neighbors, right? Come back. Yeah, exactly. But anyway, so I'm in the shower. All I know is that there's now 2 dogs hiding out on the other side of the shower this morning because my wife's threatened to beat them.
At realinvestmentadvice.com.
I'm now here at the studio because I'm afraid to be at my house. The Ring video will be made available sometime soon here. I just have to download it. Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Interesting headlines out over the last 2 days about what's going on in the Trump administration. He's been, laying off a lot of workers, the DEI departments, etc., a lot of federal workers. And we talked about the difficulty of firing an employee. Remember, we had this conversation is that when Trump was coming in office, he was like, I'm going to, just get rid of these whole departments. And we were like, hey, that's a great idea. Certainly would be good. The problem is all the federal protections for federal employment. They're very difficult to fire. And what's interesting is like, for instance, when he laid off all of these DEI workers, as an example, a lot of these DEI departments and et cetera, he had to lay them off. Which camera am I using, Brent? That one now? The big one? Okay. When he laid them off, he had to lay them off with full pay and benefits. So basically, they're on leave with full pay and benefits. So now they're sitting at home, not working at all. They're not hurting anything, right? But they're still getting paid full benefits. So again, that's not saving any money right now. Now, yesterday, he's now offering buyouts to these employees, which, you get paid through September while you find another job. And this kind of goes to the part of where he's now requiring workers to come back to work. again, so this is the challenge with our government, right? Which is once these people get involved in government, they don't quit because they've got so many guaranteed protections. But this is why government is so bloated. And we have all these employees that do nothing. They don't work much. The number of workers that were actually going into the offices, it was like 1% of federal workers were actually going into the office to work. So again, great gig if you can get it, right? And the important thing about this is that a lot of the hiring that we've had over the last 4 years in particular were all government related jobs. So you had a lot of government hiring over the last 4 years. Now that's ending, which is going to ultimately come back and impact, employment numbers if that pace of government hiring slows or declines. So we'll see what happens. But again, this was the one thing we talked. My point here is we talked about the difficulty of getting rid of government employees, and Trump's now figuring this out. Is that you can send them home, you can terminate the department, but you still got to pay them. You can't fire them. So they've got to be reassigned, what you do there is you reassign them to a job out in Timbuktu somewhere that they don't want to do, then they'll quit, right? You just kind of put them in a position to quit and you give them a buyout package. And so that's going to probably be the agenda. We'll see how this works out. But again, just an interesting reality that if you didn't realize that, it's kind of frustrating, when you're talking about, we need to reform the government, reduce our debt. One of the big problems of why we can't reduce our debt is because we entrench people into government jobs. But speaking of jobs and work, I posted out this chart this morning on Twitter and just kind of thought it was funny. This is a chart that shows how jobs will be replaced by artificial intelligence. And what the chart shows is 3 industries: sales industry in terms of cost per lead, legal doc inquiry industry, and the image creation industry. And what it shows is what AI, the cost of what AI can do versus a human. And for instance, in the sales category, AI can do it for about $75 per lead versus $700 for a human to do it. So again, huge cost reductions. A legal doc inquiry goes from $500 per legal doc to 0.001 cents or dollars, right? So just big cost savings. And so I kind of tweeted out, I said, this is the near future. AI is awesome. It does everything. Wait, what? I'm fired because AI can do my job cheaper with no benefits, no sick leave, no vacation, and no free latte Fridays? AI sucks. So I'm getting a lot of good comments on Twitter this morning, but this is kind of this is one of the big challenges, that as we talk about AI and the future of AI and all these type of things, is if AI can do pretty much everything a human can do. In other words, can I replace Brent with AI? Fortunately, not right now. I can't get a deep fake to do Brent's job, right? So, but at some point, I am sure that AI will, we could use a deep fake of me, right? All I got to do is write a script, create a deep fake, give it the script, and it'll host a show for you for an hour, and you won't even know it's not me, except it won't be nearly as funny. But, just joking. But the point is that AI is going to replace a lot of workers. So what are those workers going to do? And it was one of the comments that I got back on that post was, well, why do you need to work? Just own the AI stock. So apparently we'll all just own the stock market. That's where we'll build our wealth, and then AI will do all the labor. I'm not sure it works out that way, but the AI, there's a dark side to technology. And I wrote an article about this a while back, talking about the dark side of technology and the dark side of innovation, which is that it contributes to the wealth gap. If you are a purveyor of the technology, in other words, if you are utilizing the technology, creating the technology, whatever that is, you've benefited from that, and that's created wealth for you. if you are the person that's getting replaced by the technology, it's not worked well for you. And we've seen that gap slowly occur over the last several decades. I remember back in the early 1980s, my dad was a purchasing manager for Dow Chemical down in Lake Jackson, Freeport. And he came home one day and he was all upset. And I remember this conversation because he was very upset because they had just brought a computer into his office. Up to this point, so this is early 80s, right? Computers were just starting to kind of become more mainstream and downsized to a level that you could actually put one into an office, right? And these were the old Tandy 1000s by Radio Shack. You have to go way back. But they put a computer in his office, and of course it's running on DOS and BASIC, right? 5 1/4 inch floppy drives. But they wanted him to start putting in all the information on purchase orders, et cetera, into this computer. And so he was having this learning curve, and it was really bothering him. And he's like, this computer is going to take my job at some point. They won't need me anymore to do this job. And about 15 years later, it took his job. So, it took a while to get there, but, this has been the evolution over time. And so we have created more and more of a wealth gap in the economy, really between the haves and the have-nots, those that have and use the technology versus those that don't. And there are some protected areas of the market, the labor market, plumbers, electricians, manual labor, the blue collar workers. They're protected right now from AI, but robots are coming. And if you just pay attention to what's going on, I mean, there are now, I saw yesterday an advertisement for a robotic wall painter. So if you're painting the inside of your house, they have a robot that now shows up, you feed it full of paint, and it paints your rooms. Right? So what could go wrong? Yeah, you say that, but it was doing a heck of a good job, right? Doesn't take a lunch break, right? Don't have to pay for anything. Just pay for the paint. But the point is that, the one thing we have to kind of think about in the future, and look, I certainly don't have all the answers, is what does the future of work look like in an AI-driven world? If AI can be implanted into a robot that can do surgery, do you need human doctors that have the ability to make mistakes, right? So those are the questions, and I don't have the answers, and I'm not trying to paint a dire picture of the world or anything else. This is just an honest question that I have, which is what does the future for my job look like? Because we're actually developing AI to do my job right now, so I'm trying to put myself out of business through AI. But again, I think these are questions that we need to ask and kind of think about what that means, because as we go forward, a lot of us that are investing in the markets right now, we're taking advantage of AI. We're looking at the future of AI and say, hey, this is great. But there's also this other side of the equation of when you start getting AI replacement of jobs and labor and these type of things. And, those innovations are coming. You cannot deny that those innovations are coming. And from, again, just another good example, there was a whole news piece out yesterday on robotic taxis and the evolution now that the robotic taxis will become much more mainstream over the next 5 years. So now you're getting into cars, which is interesting, by the way. It's when I was growing up, I was instructed to never get in a car with a stranger. And now we just get an app out so that we can get into cars with strangers. It's just the most bizarre. It's
never get in a car without a driver.
Yeah, and now we're saying get in a car without a driver. But now, but that's a good point though, right? So now we have those robotic taxis. Well, what happens to taxi drivers? What happens to Uber drivers? Right? If I don't need them anymore. So these are all the things. These are things I'm just thinking about because I have to, trying to manage money. I'm trying to think about where the world goes to next. But there's certainly some concerns on the labor front And again, a lot of people's immediate response is, well, this is why we need universal basic income. We just give everybody money. Well, where does that money come from? You got to earn money to pay taxes to create the revenue to issue the UBI. It's a wicked web we weave. All right, quick break. We'll come back, wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
You're listening to The Real Investment Show.
All right, welcome back to the show. Just getting ready to kind of wrap things up here for the day. Of course, this afternoon we have the Fed meeting. That'll be at 2 o'clock will be the announcement. And, of course, we'll get the press conference right after that. On, kind of the, and then also today, just economically speaking, let me just get through that here real fast. Quite a bit of data here over the next 2 days in particular, but today, and I'm trying to bring a calendar up here real fast. We've got retail inventories out today, goods trades balance today as well. A lot of stuff on, basically have, all of our gasoline related data comes out today. So we'll start to see consumption trends on gasoline, what's happening there. And if you pay attention to, kind of the supply demand of gas, it also kind of gives you a little bit of an insight into the actual economic underpinnings. If it's really strong, that means a lot of transportation's doing well, et cetera. People are consuming stuff, driving around, doing those type of things. So pay attention to that. Also have all the mortgage information out today. Tomorrow is the GDP number. I couldn't remember if it was this week or next week, but it's actually tomorrow. So we'll get the fourth quarter GDP tomorrow. That's expected to come in at 2.8%. Consensus is 2.8. The previous was 3.1. The Atlanta Fed, as of this morning, as I was saying earlier at the open, is at 3.2. So again, we could see a little bit weaker number kind of come in. Forecast are kind of all hovering right around 3%. So if that number comes in a little bit weaker, that may weigh on markets here a little bit. We'll kind of see. But again, the big number out of that is twofold: is the core PCE prices, as well as the GDP deflator. So we'll get both of those out as well. So we'll kind of see kind of what's happening within the economy, inflation, et cetera. One of the things that, and again, I've showed you this before on SimpleVisor. Brent, if you can bring this chart up for me. I've showed you this before on SimpleVisor, is that we do a lot of relative and absolute analysis. And and there's a couple of things you can do on SimpleVisor. You can look at individual sectors of the markets and look at relative performance to the S&P, what's lagging, what's leading. Or you can also do factors. So we have a whole long list of factors. It's been interesting, despite all of the turmoil in the markets here as of late, particularly relating around, NVIDIA and a lot of the tech stocks on Monday. We saw that kind of big rout. Mega cap growth, ARC, which is the Cathie Wood's kind of disruptor technology. We use that kind of as a benchmark. No, go back to the full thing because I want the list more than the chart. But the ARC basket, which is kind of our measure for the disruptive stocks like Roku, et cetera, those have been grossly outperforming. They're very overbought. And I need the actual sectors, Brent, to the left, the names. Just go back to the original full screen you had. That was perfect. On kind of the most oversold right now, what's interesting about this is that high beta is very oversold right now. Emerging markets, small caps and mid caps have been doing, not well. Just recently, and the Russell 2000 in particular is really dragging relative to the overall market. So this whole kind of hope that we were going to see this big rush into small caps really hasn't materialized as of yet. But on a relative basis, they are very oversold. So we may see some money rotation, over the course of earnings season or over the next month. We may see some rotation into these more oversold sectors. And again, the equal weight S&P 500 actually did well on Monday, not so well yesterday. So we saw a little bit of a blip of outperformance, but the equal weighted S&P 500 is decently oversold relative to the overall markets. Again, on a performance basis. Now don't move, Brent. Just stay where you are. You don't need to do anything. I'll let you know. I know. I'm just changing screens. It is okay. So it'll be exactly the same size. But if we take a look at the actual individual sectors of the markets, which are also kind of moving right now as well, utilities very, very oversold. Now that most of that sell-off in utilities occurred on Monday, but we've seen a bit of a sell-off in utilities here recently. Utilities, technology, not surprising because of Monday. Energy. That's related to the utilities trade as well, because again, the expectation is that we were going to use all this natural gas for powering, and now maybe we don't need as many data centers. That's the thought. But that pushed those sectors into deep kind of oversold territory on a relative basis. Communications, financials, consumer discretionary. We saw a lot of money rotate into those on Monday, so they're very overbought. So again, one thing that we kind of talk about here on the show is watch for these rotations, because these rotations occur on a regular basis. So again, going back to what we were talking about earlier, if Monday really kind of rocked you mentally because you had too much risk in your portfolio, this is a good time to look at, okay, well, what sectors are really oversold here? Maybe there's an opportunity there to add some exposure, trim some exposure to my high risk, high beta areas, and reduce some of that volatility risk in your portfolio. And again, this is why we talk about on SimpleVisor in particular that use this analysis to help you kind of determine where money is going to. As we talked about the open segment of the show today, we're talking about money flows into the markets, and money flows are still coming in. The Triple Q had its biggest inflow since 2021 on Monday. We saw there's been no let up of money flows coming into the market. The question is, where's it all going to? And so this is why you want to kind of separate out these real bearish headlines. It's like, oh my gosh, this is the watershed moment. You need to short the markets, etc. Now you can leave this chart, Brent. But you want to be careful of that. It's better to just pay attention to where's money flowing to. And then, as kind of Wayne Gretzky once said, look, I want to know where the puck's going to. Well, that's what this relative rotation analysis tells you. It tells you that there are sectors of the markets that are out of favor, and that's likely where the puck is going to go to next, because money will rotate as you take profits in one area, something will happen, and money will rotate into another area. And then when that sector gets really overbought, it'll rotate back to where it was before. And that's how markets work over time. It's just this rotation of money through the markets. And this has gotten to be a lot more visual over the course of the last, I would say 10 years. These sector rotations used to take, several months to a couple of years to occur back in the day, right? Now these rotations occur in a matter of weeks sometimes. Sometimes they occur in a matter of a few days. We'll see something out of favor, immediately come back into favor, and money will just run over there real quick, and you'll see a big run up in certain markets, right? So these rotations happen in the markets. And again, just, when we're talking about portfolio management, we're talking about risk management. Monday was a great test day for your portfolio. And again, if it kept you up Monday night and, you are just kind of sick to your stomach, you don't want to deal with that. That's just too much risk. And that leads to making emotionally bad mistakes. This is where we wind up selling bottoms and doing all the wrong things, and which typically impairs long-term returns. And that's why I said on Monday, just turn everything off. Don't pay attention to it. Go away. Let the market digest this. There was nothing you could do Monday morning. When the markets opened Monday morning, everybody was like, "Oh my gosh, I have to sell Nvidia." No, it was too late. If you hadn't sold Nvidia beforehand, it was too late to do anything. So you just have to wait and then let the market kind of sort itself out, which we saw yesterday a bit. And so now you've had this kind of reprieve rally here, and Nvidia is a good example. And so if you need to reduce your risk, this is a better time to do it than doing it the other day. And again, I'm not saying sell everything. I'm not saying that at all. But again, if you have a 5, 8, 10% position in Nvidia in your portfolio and everything else is 1 or 2%, you've got a concentration risk in one position that's going to move your whole portfolio. And this is the way, we think about things in our portfolio. We look at a position, we say, okay, this position has a 2% position within the portfolio. If the entire market goes, if that entire stock goes to zero, the maximum impact it's going to have on my portfolio is 2%. I can survive that, right? Can I survive a 20% position going to zero, right? So you have to look at each position as an individual and how the impact of that affects your overall portfolio. And so if you're holding a position and when it's going up, it's great, right? It's like, I own this 10% position. So every time it goes up, 1%, it's adding 10% to my portfolio return, whatever, right? That's great when it's going up, but it works in reverse. And you have to remember that everything works in reverse. So, this is why we talk about asset weighting, portfolio allocations, rotations, all these type of things. That helps you manage your risk better so that you don't. And again, this all comes down to just avoiding that emotional reaction that leads to poor outcomes in portfolios over time. And that's the emotions get to all of us. It gets to me, it gets to everybody. Trying to build your portfolio to avoid that and to limit those emotional reactions will provide better returns over the long term, because you're not going to wind up making as many mistakes. So anyway, enough of that for today. Be back tomorrow with Michael Leibowitz. We'll talk all about the Fed and what they say today and the impact on markets, inflation, all that. We'll cover that for you. Be sure and subscribe to the channel. We need 100 subscribers to get to 30,000. So if you haven't subscribed to the channel yet, please hit that subscribe button on the YouTube channel. We certainly appreciate it. And also smash that like button. That helps the algorithms as well. Gets our videos out there for us. We do appreciate it very much. All right. Have a great day. See you back here tomorrow.